Mortgage rates are rising after last week's jobs report. You're definitely going to want to watch this one. We're going to get into some serious economic data here and explain what this jobs report that came out the end of last week means for folks that want to buy or sell, and just really how to navigate the current market. And if you get some value out of this episode, if you can do me a favor, subscribe to the channel, like the video. It would mean a lot to us here, but only if you learned something and you thought this was helpful. So let me explain exactly what's going on. So interest rates rose up to 7 5/8 at the end of last week, and some people are projecting they're going to go even a little higher to maybe 7 7/8 or 7.75, those kind of next upticks in the market here because of the jobs report that we saw last week. So unemployment remained unchanged at 3.8%. We saw 336,000 new jobs get added to the payroll reports, and that is a massive increase and way more than a lot of people expected. Specifically, these industries added the most jobs. Leisure and hospitality, no surprise there given that people are going out and doing things more. Government, healthcare, professional, scientific, and technical services, and social assistance. So we're seeing all these jobs get added, and a lot of experts, Logan Mohtashami from Housing Wire in particular, he's a big believer that these jobs are getting added because of pent-up demand. If you were to look at where we would project nationally for the number of jobs on payroll right now, if the pandemic didn't happen in 2020, the COVID-19 pandemic just didn't occur, which you can't do, but that's a way people project here. Right now, the country would have between 157 million and 159 million jobs. As of this jobs report last Friday, we are currently at 156,874,000. So we're still playing a little bit of catch up here. We're getting closer, and this may be the reason why the jobs market has been so strong. And a lot of people are calling it the honey badger market because it won't quit, it just keeps going. And that could be a major reason why we're seeing that. It's all pent-up demand, and we're playing catch up right now. And what we're also seeing is that wage growth is cooling. And that's another thing related to inflation that the Federal Reserve has been monitoring. So if wage growth is cooling, unemployment staying the same, and we're seeing us approach that 157 to 159 million projection of where jobs should be had the pandemic not happened, this could be a sign that the Fed and the economy is starting to come in for this soft landing that everyone is talking about. I want to read you a quote from Lawrence Yun. He's the NAR, the National Association of Realtors chief economist. Here's his reaction to the jobs report last Friday. The job market continues to crank out jobs in high figures, 336,000 in September, and over 4 million more compared to pre-COVID March 2020. It does not mean all is well. The jobs data is considered a lagging indicator, as firms will only make a job cuts decision after having cut costs in other areas. Commercial real estate in particular is flashing warning signs. Net leasing on retail and warehouse spaces is slowing. The office sector is continuing to bleed with rising vacancy rates. Community banks, many with exposures to commercial real estate, are watching their balance sheets carefully. The fast rising interest rates are breaking several sectors of the economy. The remaining sectors will also likely crack if the rate hikes continue. Given that the inflation rate is already cooling, the Fed needs to stop raising rates and strongly consider cutting interest rates next year. That would be the soft landing without the net jobs cut to the economy. So very interesting take by Lawrence Yun there, and I agree with him that seeing this data happen, the Fed needs to stop talking about raising rates, and they may need to be looking at a cut for next year, especially looking at what's happening with mortgage rates. We're getting close to 8%. A lot of predictors thought we were going to be down to 6% by the end of the year. A lot can happen between October and the end of December. The point is, this jobs market's not quitting, and it's a lagged indicator. Very similar to the inflation number, because they would target rental data in there, and rental data is also lagged. Businesses, and let's face it, the U.S. economy is a business, should be focusing on lead indicators. So I tend to agree with Lawrence Yun. So what does this mean for people right now? And what we've seen locally is that inventory supply is up. The month supply of inventory is up over 9% year over year. So we've seen a 9% increase in the number of homes that are available based on the current sales pace in the greater Philadelphia area. This includes all the suburban counties and the city of Philadelphia. So more homes are for sale. That was a pain point for a lot of sellers who wanted to move and a lot of buyers. We've seen housing prices continue to increase year over year. That's no surprise there. So we know a crash isn't coming. And once we see inventory start to peak up, if you're someone that's been wanting to buy a home right now, the rates are going to scare people off. There's a lot of confusion about how rates are so high, yet we're seeing all these other things happen in the housing market. And when that happens and people pull back from the market, there's massive opportunity for the sellers that want to go buy a new home and find the right place for them, as well as home buyers who maybe have lost out earlier in the year but have been having a tough time finding something to go move into. So the opportunity here is that rates are likely to come down at some point next year. I'm talking about mortgage rates, not the federal funds rate. And when that happens, a lot of people are going to re-enter the market. And when people re-enter the market, there's more competition, you're bidding against other folks, it's harder to find the home that you want. So the opportunity here now, throughout the rest of the fourth quarter, is inventory's rising. This might be your best chance to get the best price of the year instead of after the first of the year or when you get into the spring 2024 market. So if you're thinking about moving and there's a reason you want to move, I'd be having conversations with real estate agents right now. And if you want to schedule a call with me to talk about your goals, we're happy to do that. There's a link here right below the video. And the point is that there's always opportunity when people start to retreat. And this goes for sellers and for buyers. If you're a seller, inventory is still low. It's increasing, but it's low based on where it needs to be for buyers and sellers to have equal negotiating power in the market. So when the market starts to shift, you want to be the person ahead of the shift, not the one that's behind it. And we're seeing that with rates, we're seeing it with inventory, and this jobs market's not going to quit, and the government's going to be slow to react. So by the time the rate cuts come, which should be next year, what a lot of people are advising the Fed to do, we'll see if they actually do it, there's going to be more people that jump right back into the market as soon as that happens. And then you're competing all over again. Now, in October, November, December, less competition means more opportunity. Sellers, you get anyone looking at your home right now, they're serious about buying a property. They're not messing around. They're not one of those looky-loos that you can get in the spring market. So there's opportunity to have serious folks come through and still do transactions based on the climate that we're in. We're still at about a little over a month's supply of homes for sale in the suburbs and about a 3.5 month supply, 3.6 and change to be exact, in the city of Philadelphia. When that number goes up or rates go up, that number is going to come down. So there's always these factors you want to look at here, and that's why it's important to pay attention to this kind of data. So if you got some value out of this, like and subscribe. Otherwise, we'll keep the content coming. And again, if you want to schedule a call, just click the link.